Following the Swiss president's failure to reduce tariffs on her country after a visit to Washington earlier this week, the Financial Times is reporting that the U.S. has imposed tariffs on imports of 1 kilo gold bars, dealing a further blow to Switzerland, which is the biggest player in gold refining.
In early August 2025, Washington delivered a shock that reverberated far beyond the marble halls of power and the glass towers of finance. In a move as abrupt as it was bold, President Donald Trump's administration slapped a 39% tariff on imported 1 kilogram gold bars, a strike aimed squarely at Switzerland, the world's preeminent hub for gold refining. The decision came just days after Switzerland's president left Washington empty-handed in her bid to win tariff relief, transforming a diplomatic disappointment into a full-blown trade rupture. The symbolism was impossible to miss. Gold is no ordinary commodity. It's the bedrock of financial stability and a linchpin of global trade. For decades, it had been treated as too essential, too politically sensitive to be pulled into the churn of protectionist skirmishes. Yet here it was, dragged into the heart of Trump's tariff campaign. Switzerland, long confident in the security of its gold exports, was left stunned. And Canada, watching from across its southern border, saw the move as a chilling warning. If gold could be targeted, so could any high-value export. The impact was immediate. Traders who had assumed bullion would be spared, whether in the 400-ounce form used by central banks, the 100-ounce size traded on COMEX, or the 1 kilogram standard favored in Asian markets, suddenly found themselves facing an unexpected tariff wall. The revelation came in the form of a terse letter from U.S. Customs, confirming that under tariff code 71081355550, all 1 kilogram bars would be subject to the full 39% duty. Overnight, shipments between the U.S. and Europe halted. The gold market fractured along the Atlantic, with U.S. prices climbing above European levels, opening a rare and costly arbitrage gap. It wasn't just the price that shifted, it was the entire rhythm of the supply chain. Earlier in the year, importers had rushed to move bullion into the U.S., bringing in 43 metric tons in January alone, nearly double the country's monthly refining output, as insurance against a policy shift they suspected might come. Those stockpiles are now the only cushion keeping the U.S. gold market from a supply squeeze. For Ottawa, the lesson was stark. While gold itself is a minor Canadian export to the U.S., the playbook that ensnared Switzerland could just as easily be applied to Canada's strategic minerals, its energy exports, or its high-end manufacturing. The U.S. had demonstrated that no trade flow, however entrenched, was beyond disruption if it served Trump's broader goal, reshaping trade balances on his terms. The gold tariff showed how decades-old commercial relationships could be upended by a single enforcement notice. Prime Minister Mark Carney, already grappling with a 35% U.S. tariff on Canadian goods outside the USMCA, has treated the episode as a rallying point. While Ontario Premier Doug Ford has answered Trump's measures with public defiance and hard numbers, Carney has kept negotiation channels quietly open. His approach balances firmness with flexibility, expanding trade links with Mexico, deepening cooperation with the European Union, and insulating vulnerable domestic sectors from sudden American policy shocks. Canada's leverage lies in what the U.S. cannot easily replace: strategic minerals critical to electronics and defense industries, abundant energy resources, and integrated automotive supply chains that knit the two economies together. The gold episode underscored why Ottawa is accelerating efforts to diversify export markets, from steel and aluminum to copper, and now, indirectly, precious metals. Trump's strategy relies on surprise, targeting sectors where the U.S. can exert maximum short-term pain before partners can organize a response. Canada's answer has been to combine public resistance with deliberate, measured diplomacy, signaling it will not be caught off guard. Yet, as Ottawa works its angles, the wider consequences of Trump's expanding tariff regime are beginning to land hardest in the U.S. itself. The August 1st expansion of tariffs to over 70 countries was billed as a patriotic economic correction, a way to bring jobs back, secure bargaining power, and compel new trade deals. But within days, the strain was showing not in Beijing or Ottawa, but in Detroit, Dallas, and the daily budgets of American families. One auto supplier in Detroit warned he would have to shutter a warehouse and lay off staff. His attempt to source cheaper components from India backfired when that country too was hit with new tariffs. "Everywhere we turn, there's another roadblock," he lamented, a sentiment now echoing through multiple sectors. Major U.S. manufacturers are quantifying the damage. In the second quarter alone, General Motors absorbed $1 billion in tariff-related costs. Ford posted an $800 million hit. Stanley Black & Decker, an emblem of American manufacturing, projected an $800 million loss for the year. Even Apple, anticipating trouble, set aside $1.1 billion this quarter to cover the impact. Retail giants like Walmart and Best Buy have already begun passing costs on to consumers, with staples from shampoo to shoes creeping up in price. Reuters has documented explicit price hikes linked directly to tariffs. Even coffee, a morning ritual for millions, is now at risk, as Brazil, the source of a third of U.S. imports, faces new duties. Economists warn this may be the moment when Americans truly feel the pinch. The sectors absorbing the worst blows, automobiles, vehicle parts, and energy, are among the most visible in daily life. The data tell a similar story. U.S. manufacturing has shed between 30,000 and 40,000 jobs in just 4 months. What began as a foreign policy lever is now ricocheting through the domestic economy, cutting into corporate earnings, inflating household costs, and threatening job stability. North of the border, Canada's own pain is mounting. Since the August 1st imposition of a 35% U.S. tariff on non-USMCA goods, covering steel, aluminum, softwood lumber, and auto parts, exports have slumped. Statistics Canada reported a 13% drop in total exports in the second quarter, with energy exports down nearly 20%, hitting Alberta hardest. Yet, instead of striking back in kind, Carney is charting a longer game. This week, Finance Minister François-Philippe Champagne and Foreign Minister Anita Anand traveled to Mexico City to meet with President Claudia Sheinbaum. The mission: reinforce trade ties and rebuild diplomatic goodwill after earlier tensions over USMCA's future. Both countries now see mutual benefit in presenting a united front ahead of the 2026 USMCA review, particularly with Trump favoring one-on-one deals over multilateral frameworks. Mexico notably secured a 90-day delay on additional U.S. tariffs, an extension Canada did not receive, making Ottawa's urgency all the more acute. In 2024, Mexico accounted for just 1% of Canadian exports. But Carney's bet is that this figure can grow, providing a buffer against the volatility in Washington. The contrast between Trump's blunt force approach, raise tariffs, test resilience, and Carney's methodical resilience building could not be starker. For Trump, disruption is a tool. For Carney, stability is a strategy. And as the gold tariff saga makes clear, in an era of unpredictable trade politics, adaptability may prove the most valuable commodity of all. If the gold tariff jolted markets, President Trump's next move was nothing short of seismic. In early August, he unveiled what may be the most aggressive trade salvo of his second term: a phased tariff plan targeting pharmaceuticals. Beginning with a modest rate, the duties are set to rise to 150% within a year and could climb to a staggering 250% thereafter. Trump's stated goal is straightforward: force drug manufacturers to bring production back to American soil. But behind the blunt rhetoric lies a web of global supply chains, complex regulatory processes, and diplomatic relationships now in jeopardy. At first glance, the strategy plays into nationalist themes of health security and domestic manufacturing revival. But the scope of the policy tells another story. The list of affected countries is broad, cutting across allies and rivals alike. The European Union, for example, has already been hit with a 15% tariff on its pharmaceutical exports to the U.S., a jump from the zero rate many EU companies had long enjoyed. India, a global powerhouse in producing generic drugs and active pharmaceutical ingredients, APIs, finds itself in Washington's crosshairs as well, in part because of its ongoing oil purchases from Russia. Canada, though not immediately named in the initial rounds, is far from insulated. Its pharmaceutical sector is deeply intertwined with the U.S., exporting billions in generic drugs while importing branded medicines in return. The real threat comes not from a direct tariff, but from the administration's push for a most favored nation pricing rule for U.S. consumers. Under this policy, Americans would never pay more for medicine than the lowest price offered elsewhere, adjusted for GDP. For Canada, where drug prices are often half those in the U.S. for newer treatments, the implication is stark. Prices north of the border could be forced upward to prevent a domestic price war in America. The potential consequences are immediate and tangible. Provincial health budgets, already stretched thin, would face greater strain. The rollout of new treatments could be delayed, with patients waiting longer for life-saving drugs. For a country that has faced periodic shortages of key medicines, from antibiotics to cancer therapies, politicizing the supply chain carries serious risks. Even without blanket tariffs, the pharmaceutical link between Ottawa and Washington is becoming a pressure point in Trump's broader trade calculus. Europe is learning the same lesson. Just weeks after celebrating a high-profile trade framework in July, one that promised hundreds of billions in new investment and energy purchases, the EU was blindsided by Trump's 15% pharmaceutical tariff. The ink was barely dry, and already the trust underpinning the deal was eroding. The sudden move has left Brussels wondering whether the framework can hold, especially with retaliatory EU tariffs postponed by just 6 months. The clock is ticking, and any further escalation could fracture the deal before it's even finalized. What makes the pharmaceutical offensive so disruptive is the timescale required to respond. Manufacturing drugs is not like producing consumer electronics or assembling cars. Building compliant facilities in the U.S. takes years, enormous capital investment, and approval from regulators like the FDA. While industry giants such as Eli Lilly and Johnson & Johnson have announced plans to expand U.S. production, those projects will not cushion the near-term shock. In the meantime, companies must decide whether to absorb the tariffs, cutting into profits, or pass the costs onto consumers through higher insurance premiums, copays, and retail prices. The irony is difficult to ignore. The same executive order meant to lower U.S. drug prices could end up driving them higher, at least in the short run. With APIs from India, advanced therapies from Europe, and finished products from Canada all potentially delayed or diverted, the global supply chain is ill-prepared for this kind of sudden shock. Shortages in one link could cascade through the system, delaying treatment for patients far from the political front lines. For Canada, the pharmaceutical maneuver adds another layer of urgency to its trade strategy. Prime Minister Carney's government is already working to diversify export destinations, shield vulnerable industries, and strengthen ties with Mexico and the EU. Now, health policy is becoming part of the trade conversation, a recognition that economic security extends beyond raw materials and manufacturing to the stability of essential goods like medicines. Trump's approach to trade, whether on gold, steel, autos, or now pharmaceuticals, relies on unpredictability as a weapon. By keeping partners off balance, he aims to force faster concessions and secure terms more favorable to the U.S. But this strategy also risks alienating allies and creating ripple effects that hurt American consumers as much as foreign producers. Industry reactions have been swift and wary. Pharmaceutical executives warn that the tariffs, if fully implemented, could disrupt innovation pipelines, delay drug launches, and lead to higher global prices as companies attempt to harmonize markets to avoid the most favored nation trap. The knock-on effects could reach far beyond the sector, straining diplomatic ties and complicating negotiations in other trade areas. What emerges from the gold and pharmaceutical episodes is a portrait of a trade policy driven by leverage over predictability and by speed over stability. For Trump, these are tactical advantages, short-term pain to achieve long-term realignments. For Canada and other partners, they are strategic vulnerabilities that must be mitigated through diversification, coalition building, and adaptability. As the second half of 2025 unfolds, the question is not whether more tariffs are coming, they are, but whether America's trade partners will be ready to absorb the blows and adjust in time. In Ottawa, the focus is clear. Avoid being caught in the next surprise, strengthen supply chains at home and abroad, and ensure that when the next enforcement letter or tariff notice arrives, Canada's response is not reactive, but ready. By late summer 2025, the scope of President Trump's tariff offensive had crystallized into something larger than a series of isolated disputes. It was an economic doctrine, one that placed shock value at the center of trade strategy, Gold, automobiles, pharmaceuticals, steel, and even consumer staples were now all part of a rapidly expanding battlefield. The message was unambiguous. Any sector could be weaponized in the name of U.S. leverage. For Canada, this reality demanded a structural, not just tactical, response. The Canadian economy had already absorbed a string of blows. The 35% U.S. tariff on non-USMCA goods imposed on August 1st had hammered key industries. Energy exports, a lifeline for Alberta and a critical component of Canada's trade surplus with the U.S., fell nearly 20% in the second quarter alone. Auto parts, softwood lumber, and a range of consumer goods saw similar declines. Statistics Canada's report of a 13% overall drop in exports underscored just how quickly the trade balance could deteriorate when Washington shifted its policy gears. Yet Ottawa resisted the temptation to match Trump's moves tit for tat. Prime Minister Mark Carney, joined in broad alignment by provincial leaders like Ontario's Doug Ford, has instead pursued a dual-track approach. Confront publicly where necessary, but negotiate quietly where it counts. In practice, this has meant reinforcing Canada's role as a reliable partner for other major economies, while preparing domestic industries to withstand future U.S. shocks. Mexico has emerged as the most immediate pivot point. Once a point of contention, especially after early talk in Canada of cutting Mexico out of the USMCA, Mexico is now central to Ottawa's diversification plan. The high-level meetings in Mexico City between Finance Minister François-Philippe Champagne, Foreign Minister Anita Anand, and President Claudia Sheinbaum were more than symbolic gestures. They represented a recognition that, with Trump favoring bilateral deals, Canada and Mexico must strengthen their own economic alignment to avoid being picked off individually in negotiations with Washington. Mexico's 90-day delay on new U.S. tariffs was a small but telling advantage that Canada lacked. It highlighted the risks of going it alone and reinforced the urgency of building alliances, not just in North America, but globally. Carney's government has also ramped up talks with the European Union, aiming to lock in market access before the next round of U.S.-EU trade friction spills over into Canadian exports. Domestically, the adaptation is just as important. Ottawa is accelerating investment in sectors where Canada holds strategic value to the U.S. but cannot be easily substituted: critical minerals for technology and defense, advanced energy systems, and integrated automotive manufacturing. By emphasizing these sectors, Canada seeks to anchor its trade relationship in areas where American dependence creates mutual vulnerability, tempering the U.S. appetite for aggressive tariffs. Meanwhile, the effects of Trump's strategy are starting to bite at home in America. The same tariffs designed to punish foreign producers are cutting into U.S. corporate profits, driving up consumer prices and, in some cases, costing jobs. From coffee imports to car parts, the inflationary effects are creeping into everyday life. The auto sector, already reeling from supply chain disruptions, faces higher input costs, prompting layoffs and facility closures. Retailers, caught between rising wholesale prices and consumer sensitivity, are quietly marking up essentials from clothing to personal care products. This is where the political calculus becomes more complex. Trump's trade gambits, while popular among segments of the electorate who see them as a defense of American industry, also carry the risk of domestic backlash if the economic pain becomes too visible. In this environment, Canada's measured approach gains strategic weight. By avoiding retaliatory spirals and focusing on resilience, Ottawa positions itself as a stable partner, even to U.S. businesses increasingly weary of tariff turbulence. The gold tariff remains the most vivid example of Trump's doctrine in action, a sudden, high-impact move that bypassed the usual cycle of negotiation and escalation. It demonstrated the power of surprise in trade policy, but also its volatility. The disruption of gold shipments, the price gaps between markets, and the scramble for alternative supply lines underscored how vulnerable even the most entrenched trade flows can be. The same logic applied to pharmaceuticals, where the threat of astronomical duties and pricing mandates could ripple through health systems worldwide. Canada's challenge is to translate these warnings into concrete safeguards. This means expanding trade corridors beyond the U.S., deepening ties with markets in Asia and Europe, and building redundancy into supply chains for critical goods. It also means engaging U.S. stakeholders, state governments, industry groups, and even consumer advocates who have a vested interest in maintaining open, predictable trade. In the end, the contest is not about who can raise tariffs the highest, it's about who can adapt fastest. Trump's White House wields disruption as a lever. Carney's Ottawa counters with preparation and flexibility. The outcome will depend on whether Canada's strategic patience can outlast the shocks and whether the U.S. economy can absorb the cost of its own pressure campaign without sparking domestic resistance. For now, the pattern is clear. Tariffs are no longer just a bargaining chip. They are a recurring instrument of foreign and domestic policy. Gold, pharmaceuticals, steel, energy, each new target is both a message and a test. Canada's task is to ensure that when the next surprise arrives, it is not caught scrambling, but standing ready, with options on the table and allies at its side. In an age where trade policy is as much about political theater as it is about economics, resilience may prove to be the most valuable currency of all.